This video deals with Chapter 2, namely the qualitative characteristics of useful financial information. Now, this chapter was also included in the previous version of the framework and has not been revised fundamentally, although some minor changes were made. Now, more specifically, the concepts of prudence and substance over form have been reintroduced into the framework, while the concept of measurement and certainty has been defined. But more about that in a short while. Chapter 2 covers two aspects, namely the qualitative characteristics of useful financial information, as well as the cost constraint on useful financial information. In addition, regarding these two aspects, a distinction is made between fundamental and enhancing qualitative characteristics. In simple terms, the fundamental characteristics are those characteristics that are regarded as critical or essential, while the enhancing characteristics are highly desirable but not critical. We will first look at the qualitative characteristics of useful financial information, starting with the fundamental characteristics. For financial information to be useful, it must be relevant and must faithfully represent what it purports to represent. Okay, so the fundamental characteristics would be relevance and faithful representation. Now, as you can see from this slide, there are various aspects that we need to keep in mind when considering relevance and faithful representation. Each of the blocks on this slide will now be discussed in more detail, starting with relevance. What we have to determine is when will financial information be deemed relevant. Financial information will be relevant if it is capable of making a difference in the decisions made by users. Now, for information to make a difference in decisions, it must have predictive value, confirmatory value, or both. Financial information will have predictive value if it can be used as an input to predict future outcomes. For example, revenue for the current year that can be used to predict future revenues. Confirmatory value means that financial information provides feedback about previous predictions or evaluations. For example, revenue for the current year that can be used to evaluate revenue predictions made in prior years. Now, often information that has predictive value will also have confirmatory value. Now you know when information will be regarded as relevant. One aspect of relevance that we need to consider in more detail is materiality. Information is material if omitting it or misstating it could influence the decisions of users. It is important to realize that materiality is entity-specific. An issue that is material for one entity is not necessarily material for another entity. Materiality depends on the nature of an item, its size, or both its nature and size. Now, please do not make the mistake of viewing materiality only in monetary terms. An item can be material due to its nature, although the amount may not be material. An example of this would be if an entity speculates in future contracts. Now, although the gain or loss recognized for a specific period may be relatively small, these contracts could be material due to their nature, as there are significant risks attached to these contracts. That covers our discussion of the first fundamental qualitative characteristic, being relevance. Next, we will consider faithful representation, starting with substance over form. Financial information must faithfully represent the substance of transactions and events. Now, often the substance and legal form are the same, but if they are not the same, the focus should be on the substance of the transaction rather than on its legal form. An example of this would be if an entity sells an item, but the entity has the obligation to buy the item back at a later date at a higher price. Although the legal form of the transaction may be a sale, the substance may be a financing arrangement instead, and should be accounted for as such. That covers substance over form, which forms part of faithful representation. Now, still on the topic of faithful representation, the framework mentions that for a depiction to be perfectly faithful representation, that depiction will have three characteristics. Namely, it will be complete, it will be neutral, and it will be free from error. Now, I think the concept of completeness is self-explanatory in the sense that financial reports need to include all the information necessary for a user to understand the transaction or event, including all necessary descriptions and explanations. Regarding neutrality, a neutral depiction is without bias. In other words, it is not manipulated in any way to increase the probability that it will be received favorably by the users. Still on the topic of neutrality, this neutrality must be supported by the exercise of prudence. The concept of prudence was not included in the 2010 version of the framework, but was used in the previous version of the framework. The 2018 version of the framework reintroduces this concept in an attempt to clarify the meaning thereof, as will be explained on the next slide. Prudence is defined as the exercise of caution when making judgments under conditions of uncertainty. When prudence is exercised, assets and income will not be overstated, and liabilities and expenses will not be understated. But on the other hand, assets and income may also not be understated, while liabilities and expenses may not be overstated. So prudence works in both directions. It is important to understand that the requirements for prudence are not asymmetric. In other words, you don't need stronger evidence or more certainty to recognize assets and income than to recognize liabilities and expenses. The requirements of some standards may, however, be asymmetric. For example, in IAS 37, a provision will be recognized if an outflow of benefits is probable, while a related reimbursement asset will only be recognized if the inflow of benefits is virtually certain. In other words, the standard requires more persuasive evidence for the recognition of the reimbursement asset than for the related provision. The last characteristic of faithful representation that we need to consider is that the depiction should be free from error. Free from error does not mean perfectly accurate in all respects. Now, this is especially true for estimates. If you have to make an estimate of a value or price, it might be impossible to determine if that estimate is accurate or perhaps inaccurate. But you can ensure that the valuation technique that you use is appropriate and that the inputs into the model are accurate. Although the use of estimates gives rise to measurement uncertainty, reasonable estimates are an essential part of financial reporting and do not undermine the usefulness of the information, provided that the estimates are clearly and accurately described and explained. That concludes the explanation of the fundamental characteristics of financial information. Next, we will consider how these fundamental characteristics should be applied. For financial information to be useful, it must both be relevant and provide a faithful representation. Relevant information that is presented unfaithfully or irrelevant information that is presented faithfully will not be useful. Now, sometimes a trade-off between these two characteristics may need to be made. For example, when the most relevant information is a highly uncertain estimate. Okay, so the information is relevant, but faithful representation might be questionable due to the high level of uncertainty. In some situations, this may be resolved by providing a description of the estimate and an explanation of the uncertainties. If this would not result in faithful representation, it might be appropriate to include a less relevant estimate, which is more certain, so a lower level of relevance, but a higher level of faithful representation. If there is no estimate that provides useful information, the solution might be to provide descriptive information without an estimate. This concludes our discussion on the fundamental qualitative characteristics of useful financial information. Next, we will look at the enhancing qualitative characteristics. Comparability, verifiability, timeliness, and understandability are qualitative characteristics that enhance the usefulness of information. But usefulness of information can only be enhanced if that information is already relevant and provides a faithful representation. These four enhancing characteristics can also help a reporting entity to choose between alternatives that are considered equally relevant and faithful. We will now discuss each of these enhancing characteristics individually, starting with comparability. Information about a reporting entity is more useful if it can be compared with similar information about other entities and with similar information about the same entity, but for another period. Okay, so comparability entails comparing information of different entities, but also comparing information for different financial years. Now, this comparison will enable users to identify and understand similarities in items, as well as differences among items. It is important to understand that comparability is not the same as uniformity. With uniformity, everything looks the same, which means that unlike things look alike. For comparability, like things must look alike, but important, unlike things must look different. Now, I think it is obvious that if a standard allows different accounting methods for similar items, comparability will diminish. An example of this would be IAS 2, which allows inventory to be valued using the weighted average method or the FIFO method. Now, if one entity uses the weighted average method, while another entity uses the FIFO method, it may be difficult to compare the inventory balances of these entities. The framework mentions that consistency helps to achieve comparability. Consistency means that you use the same methods for the same items from period to period. For example, if an entity uses the FIFO method to value inventory year after year. The second enhancing characteristic that we need to discuss is verifiability. Verifiability gives assurance to users that information provides a faithful representation. In simple terms, it means that different knowledgeable and independent observers could reach consensus that a particular depiction is a faithful representation. This verification process can either be direct or indirect. Direct verification means verification through direct observation. For example, counting cash. Indirect verification means checking inputs to a model and recalculating the outputs. An example of this would be to check prices and quantities of inventory in order to recalculate the cost of the inventory on the FIFO or weighted average basis. The third enhancing characteristic is timeliness. Information should be available to decision makers in time to be capable of influencing their decisions. As a general rule, the older the information is, the less useful it becomes, so the sooner the better. The last enhancing characteristic is understandability. Financial information should be easy to understand. But what happens if transactions and events are so complex that you cannot make it easy to understand? Should these transactions then be excluded from financial reports to make the reports easier to understand? Well, I think your gut feeling tells you that you cannot exclude information from financial reports, as these reports will then be incomplete. A better approach would be to rather include this information, and if necessary, users can seek the help of advisors to help them understand the difficult issues. That covers our discussion of the four enhancing characteristics. Next, we will find out how these characteristics should be applied. The enhancing characteristics should be maximized to the extent possible. Now, the application of these characteristics does not follow a prescribed order. In other words, one characteristic is not more important than the others. Now, sometimes one of these characteristics may have to be diminished or reduced to maximize another qualitative characteristic. An example of this is if a new accounting policy is applied prospectively. The prospective application may reduce comparability with prior years, but the new policy may provide more relevant information. So in this case, comparability is sacrificed for improved relevance. This concludes our discussion of the fundamental and enhancing qualitative characteristics of useful financial information. The last issue that we need to consider is the cost constraint on useful financial reporting. The cost of reporting financial information should be justified by the benefits of reporting that information. Okay, so you need to weigh the costs against the benefits. Now, although the reporting entity incurs the costs to collect and process financial information, the users ultimately bear these costs in the form of reduced returns. For example, lower dividends due to lower profits. In addition, users may also incur their own costs to obtain, analyze, and interpret information. Okay, so what are the benefits? Users will make decisions with more confidence. This will result in more efficient functioning of capital markets, as well as a lower cost of capital for the economy as a whole. In addition, the individual investor, lender, or creditor will also benefit by making more informed decisions. For example, by investing in the entity with more lucrative prospects. What a relief. This is the end of chapter 2. Now, my guess is that you fell asleep halfway through this video. Well, I know that I did. Perhaps it is a good idea for all of us to take a break before we continue with chapter 3.